In 2000, Goldman Sachs had a trading floor in New York with 600 traders buying and selling stocks. By 2017, that number had dropped to just two traders, supported by 200 computer engineers. 600 people replaced by algorithms, and the world barely noticed. Today, between 60 and 75% of all trades in the United States are executed by machines. Not humans, machines. The trading floor that once looked like organized chaos, with hundreds of people shouting orders, now looks like a library. Quiet, empty, automated. This is the story of how artificial intelligence silently took over Wall Street, eliminated thousands of jobs, and changed the financial system forever. And most people have no idea it even happened. Let's go back to the 1980s. Wall Street was loud. Trading floors were packed with hundreds of brokers in colorful jackets screaming buy and sell orders. Phones were ringing constantly. Traders were making split-second decisions based on gut instinct and market feel. It was intense, it was human, and it was about to become obsolete. In 1983, NASDAQ introduced a purely electronic form of trading. No more physical floor, no more hand signals, just computers and screens. It was revolutionary, but most people thought it would never fully replace human traders. They were wrong. The first wave of automation came with something called program trading. In the mid-1980s, institutional investors started using computer programs to execute large trades based on predefined rules. If the S&P 500 index hit a certain price, the program would automatically buy or sell baskets of stocks. It was faster than humans, more efficient, but it was also dangerous. On October 19, 1987, the stock market crashed. Black Monday. The Dow Jones Industrial Average fell 22.6% in a single day. It's still the largest one-day percentage drop in history. What caused it? Program trading. The computers detected falling prices and started selling automatically, which caused more selling, which triggered more programs to sell. It was a cascade, a death spiral, and humans couldn't stop it fast enough. After the crash, there were calls to ban program trading. Regulators held hearings. Experts warned about the dangers of automation, but the genie was out of the bottle. The efficiency gains were too attractive. Trading volumes were exploding. In the 1960s, stock exchanges handled about 5 million shares per day. By the late 1960s, that had jumped to 12 million. The paperwork crisis was overwhelming. Wall Street clerks were drowning in paper trade confirmations. They couldn't keep up. The solution was obvious: automate. By the 1970s and 1980s, computers started handling more and more of the back office work: settlement, clearing, record keeping, all automated. And if the back office could be automated, why not the front office too? Enter high-frequency trading, HFT for short. This was the next evolution. High-frequency trading uses powerful computers and ultra-fast internet connections to execute trades in microseconds. Not seconds, microseconds, 1/millionth of a second. By the 2000s, HFT firms could execute trades in approximately 1/64 millionth of a second. Compare that to the several seconds it took human traders in the 1980s. The speed difference is incomprehensible. And with that speed came massive profits. HFT firms could detect tiny price differences between exchanges and exploit them before anyone else even knew they existed. It was arbitrage at the speed of light. By 2010, high-frequency trading accounted for about 60% of all equity trading volume in the United States. 60%. More than half of all trades were being made by algorithms, not humans. And most people had no idea. The trading floors started emptying out. Jobs started disappearing. In the 1990s, the first trading jobs to be automated were spot brokers in foreign exchange markets. Matching bids and offers was routine for computers. Then spot traders went next. Then futures traders. Then options traders. One by one, entire categories of trading jobs were eliminated. But it wasn't just low-level traders being replaced. Even sophisticated roles started falling to automation. In 2016, according to data, HFT on average initiated 10 to 40% of trading volume in equities and 10 to 15% in foreign exchange and commodities. By 2019, the percentage of equities being traded via algorithms had reached 50% globally. In India, algorithmic trading went from 10% of all equity trades in 2011 to 50% by 2019, 50% in 8 years. The transformation was rapid and relentless. Then came the real bombshell. In 2017, Marty Chavez, Goldman Sachs Chief Information Officer, revealed what everyone suspected but nobody wanted to say out loud. Goldman Sachs had replaced 600 equity traders with automated trading programs. The traders who remained? Just two. Two human traders doing work that once required 600. And those two were supported by 200 computer engineers. The ratio had flipped. Instead of 600 traders and a handful of tech support, it was now 2 traders and 200 engineers. Chavez explained it simply. Once an algorithm can determine the fair price for a stock or option, you don't need dozens of people to execute orders. The algorithm does it better, faster, cheaper. Goldman wasn't alone. Every major bank was doing the same thing. Deutsche Bank, J.P. Morgan, Morgan Stanley, Citi. They all started replacing traders with algorithms. The pattern was consistent. Replace 4 traders with 1 computer engineer. The trading floor was becoming a server farm. And the people who built their careers on market instinct and quick reflexes were being shown the door. By 2024, somewhere between 60 and 73% of share trades on U.S. stock exchanges originate from automated orders. Nearly 3/4 of all trading is done by machines. But here's what nobody talks about. The machines don't just execute trades faster. They make different decisions. Human traders have biases. They get emotional. They panic during crashes and get greedy during bubbles. Algorithms don't. They follow rules. They process millions of data points in real time. They identify patterns that humans can't see. And increasingly, they're using artificial intelligence and machine learning to predict market movements before they happen. Since 2017, when large language models started appearing, the share of AI content in patent applications related to algorithmic trading has risen from 19% to over 50%. Half of all new trading algorithms now incorporate some form of AI. These aren't simple programs anymore. They're adaptive. They learn. They improve themselves. Some algorithms can now read Federal Reserve meeting minutes faster than any human and execute trades based on the sentiment before humans even finish reading the first paragraph. Research shows that since 2017, U.S. equity prices move more decisively in the first 15 seconds outsmonths than they did before large language models existed. The AI is reading, analyzing, and trading on complex economic documents in seconds, and it's making money doing it. This raises uncomfortable questions. If AI can read and interpret Federal Reserve policy faster than expert economists, what other jobs are at risk? If algorithms can execute trades better than human traders, can they also manage portfolios better than human portfolio managers? Can they pick stocks better than analysts? Can they allocate capital better than CEOs? The answer, so far, is complicated. AI has been incredibly successful at high-frequency trading, which is all about speed and pattern recognition. But longer-term investment decisions still require human judgment. For now, portfolio managers aren't being replaced, yet because managing money involves understanding things that are hard to quantify: management quality, industry dynamics, political risk, behavioral psychology. These require intuition and experience that AI doesn't have. Yet, but the trajectory is clear. The jobs that involve routine, repetitive decisions are gone. The jobs that involve speed and data processing are gone. And the jobs that involve complex analysis are being augmented by AI, which means fewer humans can do more work, which means fewer jobs. Let's talk about what this means for regular people. First, it means markets are faster and more efficient than ever. Bid-ask spreads, the difference between buying and selling prices, have narrowed dramatically. Transaction costs have fallen. That's good for investors. But it also means markets are more fragile. The flash crash of May 6, 2010 is a perfect example. At 2:32 p.m., the Dow Jones Industrial Average started falling. Within minutes, it had dropped over 1,000 points. Nearly $1 trillion in market value vanished. Then, just as suddenly, the market recovered. The entire crash and recovery happened in about 36 minutes. What caused it? High-frequency trading algorithms. A large sell order triggered automated selling programs. Those programs triggered other programs. The cascade effect, just like 1987, except faster. Much faster. Regulators investigated for months. They found that algorithmic and high-frequency traders had contributed to the volatility by rapidly withdrawing from the market when things got chaotic. The algorithms detected abnormal conditions and stopped trading, which reduced liquidity, which made the crash worse. The machines that were supposed to stabilize markets had amplified the panic. And this keeps happening. Many flash crashes occur regularly in individual stocks and bonds. Prices swing wildly for minutes or seconds before stabilizing. Usually it's algorithmic trading gone wrong, a faulty algorithm, a coding error, or just too many algorithms making the same decision at the same time. This is the dark side of automation that nobody wants to discuss. When humans dominated trading, there was diversity in decision-making. Different traders had different strategies, different risk tolerances, different views. That diversity created stability. But when algorithms dominate, and many of those algorithms are based on similar mathematical models, they tend to make similar decisions. Research published in 2021 shows that most high-frequency traders use similar algorithms, which means when negative news hits, they all try to sell at the same time. And if there's nobody on the other side of the trade, markets can fail. Completely. Just freeze up. This is systemic risk. And it's growing. Now add generative AI and large language models into the mix. ChatGPT and similar programs are starting to be used for trading. These AI systems can analyze news, social media, earnings reports, economic data, everything, and make trading recommendations in seconds. Some hedge funds are already using them. The problem? If everyone is using similar AI models trained on similar data, they might all reach similar conclusions and make similar trades. The herd mentality that causes crashes could get worse, not better. Humans left to their own devices make diverse decisions. A one trained on the same datasets might make uniform decisions. That's dangerous. But let's be honest. The automation of trading isn't going to stop. It's going to accelerate. The global algorithmic trading market was valued at $11.1 billion in 2019 and is expected to reach $18.8 billion by 2024. The technology is improving. The algorithms are getting smarter. And the financial incentive is too strong. Why would a bank pay a trader $500,000 a year when an algorithm can do the job for a fraction of the cost? The answer is they wouldn't, and they aren't. The jobs are gone, and they're not coming back. So what happens to the traders? Some have adapted. They've learned to code. They've become quantitative analysts or computer engineers who build the algorithms instead of competing against them. But most have simply left finance. They've gone to other industries or retired early, or struggled to find work. Because the skills that made them valuable, market intuition, quick decision-making, relationship building, those skills are worth less in a world dominated by algorithms. The Hong Kong Stock Exchange closed its physical trading floor in October 2017 after 31 years because electronic trading had made it obsolete. A trader named Christopher Chiang told the BBC, "I have a deep affinity for this place. Every day, coming to work, we all sat side by side and talked all day. But I know that things are changing, and financial technology is also changing. So even if I'm not entirely willing to leave and to let this place go, we need to adjust and get with the times." That's the reality. Adjust or become irrelevant. And it's not just traders. Junior analysts are next. AI can now read financial statements, analyze data, and write research reports. In 2024, Moody's concluded that asset management firms are unlikely to replace portfolio managers with AI anytime soon. But the keyword is soon. The technology is improving exponentially. What's impossible today might be standard in 5 years. Goldman Sachs analysts have warned that as AI becomes more sophisticated, more investment jobs will be at risk. The writing is on the wall, or rather it's in the code. Here's the uncomfortable truth. The replacement of traders by AI wasn't a sudden event. It was a gradual process that happened over decades. And because it was gradual, most people didn't notice. A few jobs disappeared here. A desk got consolidated there. The trading floor got a little quieter each year. By the time people realized what had happened, it was over. 600 traders became 2, and the world kept spinning. Stock markets kept functioning. In fact, they functioned better, more efficiently, with lower costs. The machines had won, not through revolution, through evolution. Silent, inevitable, unstoppable. So what can we learn from this? First, no job is safe from automation if it involves routine, repetitive tasks. If an algorithm can be written to do your job, it eventually will be. Second, speed and efficiency always win. Human traders couldn't compete with algorithms executing trades in microseconds. They never stood a chance. Third, the jobs of the future aren't on the trading floor. They're in the server room. The people who build and maintain the algorithms are the new traders. Fourth, systemic risk is growing. When everyone uses similar AI models, the risk of synchronized behavior increases. Flash crashes will become more common, not less. And finally, most disruption happens slowly, then all at once. The replacement of traders took 30 years, but the last 10 years saw the vast majority of job losses. By the time people realized what was happening, it was too late to stop it. Today, if you walk onto a modern trading floor at Goldman Sachs or JP Morgan, you won't see chaos. You won't see shouting. You'll see rows of computer screens and a handful of people monitoring algorithms. The energy is gone. The humanity is gone. But the profits? They're higher than ever. Because machines don't take lunch breaks. They don't get tired. They don't demand bonuses. They just trade. Billions of times per day. Making tiny profits on each trade that add up to massive returns. Wall Street has been transformed, and almost nobody noticed until it was over. The age of the human trader is dead. Long live the algorithm. If this story opened your eyes to what's really happening on Wall Street, subscribe to this channel. Because AI isn't just replacing traders. It's coming for lawyers, doctors, accountants, and journalists too. And just like the traders, most people won't notice until it's too late.